We are now entering a transition period where we have competing narratives. Until one gains the upper hand or the other falls away, we may remain in relatively volatile trading ranges for some time in markets from equities to energy to gold, among others. In the equity world, the conflict is between optimism about reopening economies around the globe set against the relative pessimism about the downsizing and cutbacks in many large companies. That's due to their financial distress and the expected weakness in demand, which could continue for a long time due to the impaired incomes of their consumers. In the oil market, we have one narrative around supply being cut back by OPEC, by Russia, as well as in the United States by the shale producers as they stop drilling new wells. Nevertheless, at least in this temporary transition phase, transportation fuel demand has dropped sharply, while oil storage capacity is at a premium. This has led to what we call a steep contango in the futures maturity curve. The nearby contract for WTI oil futures is priced in the mid-teens per barrel. A few months forward, into the later summer, the price is over $20. And a year out, we see $30. The maturity curve reflects the conflicts between the near-term and the longer-term outlooks. Gold is also in a conflicted place. With short-term interest rates from the major central banks likely to stay near zero for a very long time, this narrative benefits gold because gold bears no interest and currently has no competition from short-term rates. There's also the narrative that in the long run, possibly very long run, the massive expansion of budget deficits and central bank asset purchases sets up a scenario for serious inflation. That would happen once economies have been rebuilt and returned to their equilibrium. The conflicting and relatively pessimistic narrative that appears to be in the making, though not yet confirmed, is the potential for price declines over the next 6 to 9 months as unemployment hits extremely high levels before starting to work its way down. Despite the likelihood of shortages and price rises in selected products, our perspective is that we will be, in general, in a net consumer price decline environment for the rest of 2020 and into 2021. That is, at least until unemployment retreats substantially. Now, what this means is deflation is going to benefit the holders of cash, and that may cause some volatility in the price of gold. I'm Blue Putnam, Chief Economist, CME Group.